roughly at 11 o'clock. He wanted to introduce himself. He's a senior vice president of Empower, and he leads the government market team.
Thank you.
Mm-hmm.
Okay, so we are live. We will go ahead and call the meeting to order at 10:01. And Donna will take a roll call for us.
Good morning, everyone. Roll call. Brandy Hopkins.
Present.
Matt Pollan. Matt, are you with us?
I can see Matt. I just can't hear him.
He had.
I got a thumbs up, and I will. We can take the thumbs up for purposes of roll.
Perfect. Christine Babb.
Same issue. I just saw Chrissy briefly.
Okay,
I
thank
can't
you.
hear her.
How about now?
We can.
Now,
Thank
Hi.
you.
Okay, Jay Wilverding.
I'm here.
Catherine Miller. Supervisor Miller.
I do not see her, Donna.
Okay, and Fonse Kielkum.
Here.
Thank
Good
you.
morning.
Good morning.
Hey. Thank you, everybody, for joining us today and for accommodating the schedule change. We have them all on everybody's calendars now. So again, thank you. The first thing we have on the agenda is approval of the minutes from our quarterly meeting of October 29, 2020. 1, 2, 3. Jason, I just want to confirm we have Ms. Babb, Mr. Wilderding, and Mr. Keekum. So we're good to go ahead and vote on those. They were all present at the last meeting.
Yes.
So if our members who were here for the last meeting could review those and provide a motion, it would be appreciated.
This is Fonse. I'll make a motion to approve.
Do we have a second?
Looking for a second from Chrissy,
Yes.
Jay,
I'll
or
second.
Brandy.
I
There we go.
second.
And then we'll take a roll call vote.
Okay. Brandy.
Approved?
Matt Pollan.
Matt wasn't present for that meeting.
Ready.
Yeah.
Was Jay there? Jay Wilverding.
Yep, approve.
Okay. 2, 3,
That's good.
4.
Thank you, everybody. Next, we have public comment. So as a reminder, public comments are limited to 250 words or less. They may be submitted by emailing sjcdcac publiccomments@sjgov.org. Every effort will be made to read all of the comments received into the record, but some comments may not be read due to time limitations. Comments received after an agenda item will be made part of the official record on file with the committee if received prior to the end of the meeting. Donna, do we have any public comment today?
We do not have any public comment.
We do not have any public comment today, which moves us on to our first agenda item. We did move the agenda around a little bit today, so today Vincent Galingo is going to go first. As he has another commitment later on. He's going to present our quarterly performance review for the fourth quarter of 2020. Vincent, are you on the line?
Vince, I think you're on mute.
I was going to say I talked to him. There. Oh, that's Bob. We have some limited view. Can anybody on the committee actually see Vincent?
I can see him.
Okay.
Yeah, I can see him too.
He says on the phone, yeah, Vincent, I see your mouthing, but no audio at this point. Oh, and Supervisor Miller has joined us as well.
Oh, wonderful. Good morning, Supervisor Miller.
She may also be having audio problems.
Okay.
She's on mute.
Vincent, are you able to unmute yourself? There is a telephone number you can call as well. If you need us to send that. Wave at
This
Jason.
is Sheena.
I can't.
He's making hand motions that he is calling in.
Okay, thank you, Sheena.
Yep. You're welcome.
Okay, how about now?
We can hear
Yes.
you.
Yeah.
Perfect.
Thank
Okay,
you.
so I wasn't on mute, but for whatever reason, anyway, I'm glad that people can hear me now.
Good morning. Thank you for joining us.
Yeah, good morning. I miss everybody seeing the committee in Stockton, but this will have to do. Committee, how should I do this? Do you want me to share my screen? Do you want to just follow along? Tammy, do you want to share your screen? What's the best way to spend the next, I don't know, 20, 25 minutes?
Vincent, if you're able to share your screen, I think we would appreciate that, and that way you can drive your slides as necessary.
So let me see if the San Joaquin County performance report is in front of everybody.
It is.
Okay, let me expand it because a couple of the charts are on the smaller side. We've had a nice quarter, a nice year from an economic and market standpoint. I don't want to diminish at all the economic pain that we felt, as well as the medical and health issues throughout the world. This is merely a comment on what we're seeing with the economy, the markets, as well as the overall San Joaquin County plans. With the leading economic indicators that I typically talk about, a lot of people are saying, Vincent, how can you say that the year was okay from an economic standpoint when we saw a huge shuttering or shelters in place and large chunks of the economy shut down? Well, the data points, I'll cover those and just explain kind of what's propping up the economy. So the chart on the upper left is the gross domestic product. This is a measure of our economic output. It's the dollar value of all the goods and services produced in any country in any given year. And you can see for the last several years, the economy was humming along until the first part of last year with the pandemic hit our shores. Large chunks of the economy shut down, as I said, and GDP fell off. In 2020, the first quarter GDP number was -5%. Second quarter was -31.4%. Third quarter snapped back, +33.4%. And then the fourth quarter advanced number just came out, +4%. And that's thanks in large part due to a tremendous amount of stimulus flowing through the system. We had Congress and the administration approving large amounts of relief, but also we've seen low interest rates, and that's generally a good tailwind for the economy because when the cost of capital is low, the cost of borrowing is low. A lot of people use that to stimulate the economy, and those are the reasons why, despite the pandemic, we did see a rebound with GDP numbers. Similarly, the chart on the upper right, you can see the unemployment rate. During the first part of last year, the unemployment rate spiked to just under 15%. It has come back down. Nationally, it's about 6.7%. There at the county, it's about 10.5%. So a little bit worse than the national average, but still dramatically lower from the early part of last year. So all in, fairly good news. Speaking of low interest rates, one of the biggest drivers of the rebound of the economy is an aggressive Federal Reserve. The Federal Reserve is our central bank here in the United States. Jerome Powell came out and said that the Federal Reserve was going to keep rates low for the foreseeable future. So essentially, they keep rates low on the overnight side, but they're actively buying bonds in the marketplace to keep rates low on the longer term of the yield curve. And I think the biggest beneficiary is low mortgage rates. A lot of people are refinancing, and so that's really propping up the economy. But bond math 101 is as rates drop, the value of existing bonds go up, and that has propped up the bond market last year. So in the upper left of your screen, you'll see the second line down, the U.S. aggregate. This is a good barometer of our bond market or fixed income marketplace. Historically, the ag has averaged about 3% a year, maybe 3.5%. Take a look at last year. The ag was positive 7.5%, which is pretty phenomenal. Taking a couple lines down, you'll see the TIPS index or Treasury Inflation Protected Securities. You can see 11% year last year. And then last but not least, the higher risk junk bond or high yield index over 7% last year. So nice rally on the fixed income side. And then that trend has continued on the stock market. The U.S. stock market is represented by the next page, upper right, the S&P 500, the 18.4% last year, driven thanks in large part to that 12% return just in the last 3 months of 2020. And then on the international side, you can see the ACWI or All Country World Index, next page, upper left. This represents about 45 countries outside the United States. You can see up almost 11% last year. So between the U.S. stock market, the international stock market, and even the fixed income market, nice return in 2020. So I'll pause to see if anybody has any questions, comments. All right. Hearing none, I'll go ahead and flip ahead to the next section. This page is the overall menu and asset allocation of the 457 program. A couple things to note. You can see about 35% of the total plan assets are in this guaranteed interest account. The fund that is currently on watch is this American Beacon. The only reason I bring it up is because sometimes committees like to see the overall asset exposure. Just over $5 million or 1% of the plan assets are in this particular fund. This 2065 fund was just added, the longer dated vintage of the T. Rowe Price target date funds, and you can see not a lot of adoption, $15 in that particular suite. And then you can see just under $500 million in the total plan. It's worthy to note because just 2 years ago, the plan had $385 million. So thanks to some cash flow characteristics, but strong market gains, the plan has grown rather dramatically in the last couple of years. So questions, comments? All right. Flipping ahead, speaking of cash flow, and this is one of the things that we've talked about, we have seen some significant money going into the program, but we've also seen slightly more money leaving, and that has been consistent, at least from a reporting standpoint. We've talked about it with the different financial advisors targeting your employees and former employees to roll money out of the plan. But you can see for the quarter, we track all the money going in. This is a cash flow positive. So $5.7 million for the quarter. And then all the money leaving, and that's a $7.5 million. So through math, we take that, and for the quarter, it was 1.8 to the negative, hence the parentheses, bringing that year-to-date number just under $400,000, but still negative. And that trend certainly was true in 2019 as well. We saw a $3.5 million lead. But thankfully, we've seen some significant market gains, as I said, about $53 million to the positive last year alone. The average account balance grew by about $6,000, ending the period just under $80,000, which is pretty attractive. And then flipping ahead, we have the 401A plan, same menu, but obviously different asset levels. You can see different asset allocation as well. Only 20% exposure to the GIA, about 20% to the target date funds, and then at the end of the year, just under $23 million within the 401A plan. And then skipping ahead to page 15, you can see slightly different cash flow characteristics over the last couple of years. Certainly for the quarter, the plan did experience some negative cash flow on a net basis, just under $8,000. More left the plan than came in. But that's tracking pretty nicely because over the last couple of years to the positive, it's been about $1.5 million each of those years. And then a pretty phenomenal average account balance, growing by about $15,000 for the quarter, ending just under $155,000. Again, very, very attractive from an average account balance standpoint. Moving forward, as I said, we do have one fund on watch. We have the American Beacon International Equity. It was placed on watch due to underperformance as well as the qualitative. We did see a significant manager change, but no real concerns with that change. In fact, we think that the change is for the better, and the weak performance was because of that departing manager who was essentially terminated and replaced. But that's the reason for this violation of the investment policy statement metrics. You can see all the other funds are performing in line with the expectations and no real concerns. So I'll pause, answer any questions, take any comments. Okay, hearing none. This is the performance reporting page, a lot of data points. Essentially, every primary colored row is a fund on the menu. Directly beneath the performance in that primary colored row over different time periods is the performance of the underlying index in the investment policy statement. And then the numbers in the grayed out rows are peer group rankings. And these numbers, because they're percentiles, will always be from 1 to 100. And we're looking for numbers closer to 1 as opposed to 100. And so we see a lot of really, really low numbers, meaning closer to 1. You see MetWest total return for the quarter, a very high quality manager. In fact, 80% of that portfolio is A or above, so very high quality fixed income portfolio. And you can see in this somewhat unique quarter, underperformed at 76th percentile. And going through, we see no real concerns, but certainly stop me if you have any questions about any of the other funds. We have no long-term issues, even with the fund that's on watch. Our recommendation is to leave it in the menus and leave it on watch. But I'll pause as I go through this. If anybody has questions, concerns. So moving ahead to the fee analysis page, this is one of the things that we report on. It's a fiduciary responsibility, and we report on it because we monitor it, making sure that fees are transparent, making sure that fees are reasonable. And so as we go through this, here's an accounting, if you will, of the underlying economics where we take all the investments in the 457. The assets for the quarter are in this middle column. We take a look at the expense ratio. This is what participants pay the fund managers to invest in these options. And then the admin fee. This is the explicit tack-on fee that participants pay in addition to the expense ratio to run the program. And through math, we take these two percentages, multiply it by the assets, and get this dollar amount column on the far right. And so you can see on an annualized basis, roughly participants are paying about $1.8 million to the managers and about $500,000 to administer the program. And the accounting of this 9 basis points or 450,000-ish for the year is accounted for here. So if you remember, 4 basis points of the 9 goes to MassMutual / Empower. That's at $200,000. The extra, or the 5 basis points, is retained by the plan to pay for plan-related expenses, and that's about $250,000. And so you can see roughly on an annualized basis, really the overall economics, and there are no real concerns with any of that, at least from our standpoint. But I'll pause to see if anybody has questions or comments on the fees in the 457. Okay. Hearing none, I'll skip ahead very briefly to the 401A plan. A lot different asset levels, and so the numbers are similar, but the amounts are different. Remember, $22 million in the 401A, the same investments, the same tack-on fee expenses. You have about $85,000 on an annualized basis going to the fund managers in the 401A program, about $20,000 collected under the 9 basis point fee. Mass Mutual is collecting $9,000 roughly annually, and then $11,000 is retained by the 401A plan or the committee to use to administer or pay for plan-related expenses on the 401A side. So, any questions on my report?
Looks good.
Yeah, all in. Again, despite everything that we're seeing in the news, the plans are performing in line as what we'd expect, and it's relatively good shape. All right. Madam Chair, I'll defer back to you and the rest of the agenda. Thank you very much.
Thank you, Vincent. I always appreciate your report. I always learn something.
Good. Thank you.
Next on our agenda is to do the introduction of Dan Morrison, but Bob, if I understood you correctly, he will not be calling in quite yet.
Yeah, Dan should be calling in right around 11 o'clock, Brandy. So if it's okay to just skip over item 4 for now, and then I can pick up item 5 and we can proceed through the agenda.
I think that would be great. And I know your report and Vincent's always tie into each other, so that would be great if we could go ahead and do that.
Okay. Great. I will see if I could share my screen to put my report up. All right, is everybody able to see the Your Plan at Work plan review?
We are, yes, thank you.
Okay, great. This is the quarterly plan summary for the fourth quarter. So I'm gonna go ahead and go through this, and then at the end, I'll flip it over to David, and David will talk to you about his activities for the quarter and really for the whole year of 2020 as outlined on that last page. So front page here, as you all know, Empower Retirement acquired Mass Mutual's retirement business, and that transaction did go through as anticipated at year end. So beginning in January 1st, we all woke up. We were Mass Mutual employees on 12/31, and David and I and many others are now Empower employees as of January 1st. And that's what this disclosure on the front page basically is saying, is that transaction has gone through. We're now operating as Empower Retirement. Executive summary, plan assets. I know Vincent covered a lot of this already, so I'll be somewhat brief. $496 million is the current total, or I should say current as of the end of 12/31. Looking at your plan balance as of yesterday, you are now at about $505 million. So you've crossed that $500 million threshold. So congratulations on achieving that milestone. And, you know, now it's off to, we'll chase after that $1 billion marker next, I guess. But total plan, outstanding loan balances, this is a new item, the second row, $329,000 at year end. The loan program, as you know, is something new. We initiated it in November of last year. So at year end, it was at $329,000. Participant contributions are shown next, both through payroll and rollovers that were coming into the plan. They totaled about $637,000, or excuse me,
200.
about 637,000 more than the totals for Q3. So participant contributions and rollovers were up about 637,000 over the previous quarter. Employer contributions, you can see next, 247,000. Withdrawals and distributions, if you add everything together, withdrawals, terminations, and loans, it came out to 6.8 million. And that led to the negative cash flow that Vincent had mentioned earlier, about 6.8 million coming out and a little under 5 million coming in through payroll and rollovers. Plan expenses, 106,000. Most of that is the asset fee that Vincent covered. So as plan assets go up, you can expect to see that expense line item also go up. Investment income at 39 million, very strong quarter. 20 million, 20.7 million was for the third quarter. Next slide is showing total participant count on the top. Pretty flat, 6,249, so a net decline of 2 over the course of the quarter. Average account balance up about $6,000 to $79,477. And you can see 21 outstanding loans as of year end. I know Tammy's going to have a report with a little more current data later on. Average loan balance at about $15,000. Very much in alignment with what we would typically see in a loan program. And then you see the activity for the quarter, calls to the 800 number, mobile app usage, and total website visits. Overall, flat to a little bit higher when you look at the website totals. Plan balances by investments. Not a whole lot has changed here. Vincent mentioned, the general account holding about 35% of the plan's assets as of year end at just under 173 million. The one thing that I did take note of that's a little different is the transfers. This number in the middle column, 4.8 million in transfers. That's coming into the general account. So people moving money out of something else, putting it into the general account. And it looks like if you look down this column, you can see where the money is coming out of. These three on the bottom had fairly heavy transfers out and into the general account. And I think what the trend was for this quarter, for whatever reason, is people were moving money into the general account and eventually also moving money out of the plan. That was the negative cash flow that we saw. Looking down this page, target date funds collectively are the second largest investment. If I add up all these percentages at year end, target date funds represent about 16.5% of plan assets. Vincent mentioned the 2065 fund that was added as of November 30th per the committee's direction. Looking at page 2 of this report, you'll see a couple of zero balances at the end of the third quarter. Those were funds that were not in the plan at that time. Those are the ones that were recently added. The MFS Mid-Cap Growth Fund was added on November 23rd and replaced the Vanguard Mid-Cap Growth Fund. So at the end of the quarter, you could see Vanguard is at 0. MFS has the balance of about 7.9 million. Same thing happened down here. The Hartford International Opportunities Fund started the quarter at 10.2 million, ended at 0. Those funds were mapped into the Vanguard International Growth Fund. Again, that happened on November 23rd.
Hi, Bob. If I can also add, one of the reasons that those three funds, the equity fund, the index fund, and the T-Row Large Cap Growth Fund, had negative transfers, participants felt that they had a good amount of growth on those funds and were also rebalancing their accounts during that time because those funds were relatively strong performer. So part of that was just a factor of employees being responsible and rebalancing when they felt they needed to.
All right. Thank you, David. The next couple of pages is the same report, but for the 401A plan. And you'll see, a similar story here. The general account is the largest holding, although not quite as large, at 20% of the plan assets, $4.6 million. Target date funds collectively have about 18.2% now. That's up about 2% over the last quarter. And you can see this report does not show the 2065 fund because in the 401A plan, there are no assets yet invested in the 2065 fund, but it is available. This report's only displaying funds that have a balance in it at the end of the quarter. And you can see MFS, mid-cap growth, started with a zero balance, ended the quarter with a $482,000 balance, and that money came from the Vanguard mid-cap growth fund. Started off at $390,000 roughly, ended at zero. Same thing here, Hartford International Opportunity moved into the Vanguard International Growth Fund, again on November 23rd. Cash flow analysis, this is really just the graphical version of what we already discussed during the plan summary. Investment balances, this is showing by fund where the money is invested, and it's also broken out by type of account. So you can see the actives versus beneficiary account holders, those in a retired status versus terminated or quadro. And then over here, you're looking at the number of people that have investments in a particular fund. So the guaranteed interest account, still the largest single holding at 2,809 accounts. And this represents the percentage of payroll. We looked at the last payroll in 2020, and that payroll breakdown, about 20.7% of the dollars coming in through payroll were allocated into the general account. Again, the target date funds collectively, 3,298 accounts. That's up 28 account holders from the previous quarter. And collectively, if you add up all of their contribution percentages, it was 50.3% of the payroll that was submitted at the end of the year was being directed into the target date funds. So we should continue to see growth over time in those target date funds because that's where roughly half of the contributions are being directed. And then on this page, I'll just focus your attention on the bottom line there that shows that breakdown of accounts. Did not change a great deal in total. Again, 6,249 participants is down 2 from the previous quarter. Active participants is down 45 from the previous quarter. Beneficiary account holders at 40 is down 3, or excuse me, that's up 3 from 37. Number of retirees is up 18. Number of terminated participants up 22. Quadros at 25 remained the same. This slide is showing you a breakdown of how people are investing by asset, by age category, so asset allocation by age category. And we're continuing to see, I think, what we want to see on this page. Number one, average account balances are growing steadily as people are getting older. And down below, or in the middle, I should say, if you look at it graphically, you can see how the asset allocation mix and changes as people get older. And you're seeing pretty much what you would expect to see and want to see, which is the younger folks are much more aggressively invested than the older employees or participants. So this blue bar is the guaranteed interest account, stable value. And as you can see, the younger folks, not too much is invested in that stable value area, but as they get older, they're becoming more conservative over time with their investment, which is typically what you would like to see. This is another chart that just kind of goes to asset allocation. There's 3 circle charts here in the far left. Number of options held by participants. You can see 61% of participants have their money in one investment option versus 23 that have 5 or more investment options. Now, it's okay if you have one option, and especially if it's a target date fund. And we know now that about 18% of the population has a target date fund. The second chart is taking this portion and saying of those people that have just one investment, and if we remove those people that have an asset allocation or a target date fund, what are they investing in? 89% of them are investing in stable value. And then if we look at that 89% wedge, we come over here. Of those people that are selecting stable value as their only investment, what is the age breakdown? And you can see about 79% of those people are age 50 and above. So again, stable value being used most heavily by those that are closer to retirement. Participant interactions, not any huge changes. This is for the fourth quarter. And you can see from website activity, the breakdown of what people are doing when they log in to check on their account. The next slide is the third quarter. So you can see between the two, there's not a whole lot of change there. The top categories that people are looking at are pretty much the same. The toll-free number, there's a little bit of change up there. Terminations, transferred calls, and investments are the top 3 for Q4. And terminations, transferred call, and hardship were the top 3 in Q3. But overall, not a lot of changes there. People are continuing to use the services as needed. And now to close out this section, I'd like to invite David back into the conversation, and he can talk to you about his meeting results for the quarter and even for the year. David?
Thanks, Bob. So 2020, we started off the year ready, for on-site meetings and presentations and everything else. And you can see that in that first box on the top of this page. That has Q1 2020 meetings. We had quite a few on-site meetings, and everything was going smoothly, and as we expected. But in March, we had to switch everything over to doing virtual meetings. And thankfully, looking back now, over 10 months of doing that, that came out to be pretty successful. We've been able to target a lot more people we've been able to target different people than who we normally see at these meetings. We've been able to have better access at places like probation or behavioral health, or even Mickey Grove to communicate with people that we're not normally going to see face-to-face regularly. Marketing that, we've been able to market, we've tried a lot of different things over the last year to try to capture people for these virtual meetings. But they've all of our methods have been pretty successful, sending out some kind of message to the department or to all employees, maybe 30 days or 14 days in advance to get people to sign up for these meetings. And these meetings, as a reminder, these are retirement education meetings. Someone sitting down to try and understand what their next best steps need to be for them to retire and move on. So they make sure rates, they make sure that they're saving an appropriate amount, and they make sure they might have the right asset allocation to meet their needs. And then we're going back to review this and change it as maybe their goals change or their preferences and comfort levels change. And it is education. It's making sure the employee is understanding what they're doing and how to move on and focus on whatever their goals are. Doing these virtual meetings since March until now, those have also been able to be a little bit better focused because the employee has to spend a little bit more time going to a computer and clicking a link as opposed to just walking down the hall and sitting in front of me. So the employees are a little bit more focused, and it does feel that the meetings are a little bit more productive. The first 3 quarters of the year, Yes, just normal meetings, and we've been able to capture the same number of people virtually as we had been doing face-to-face. But Q4, the bottom section on that on the page in front of you, thanks to help with Sheena Dupé and the National Retirement Security Month presentations that we've been doing, we had a very successful quarter with lots and lots of group presentations on topics like retirement readiness and asset allocation and things like that. And those were very successful. So Q4 at the bottom, altogether 52 days of meeting, of 52 days on the calendar of meetings. Those were very successful. That went really well, and there was a lot of engagement there. Also, starting in September of last year, new employee orientation was also being done virtually, and I've been invited to that, where I have a few minutes to speak about the plan and encourage employees to sign up on day one. Now, in the past, I would do that in person, and they would have a physical piece of paper, sign this paper, make sure you're moving in the right direction for retirement, if that's comfortable for you. We're constantly working with HR to make sure that now that it's virtual, employees are still filling out that paperwork if they need to be saving for retirement. So that's been constant tweaking over time, and HR has been very helpful on working with us to make sure we're making sure that messaging is being sent out correctly, and we're giving employees opportunities to sign up. But at virtual new employee orientation, enrollments are a little bit lower than traditionally in the past. But aside from that, the meetings have been doing very, very well. On the bottom right of the screen, you can see the total numbers year to date. You can see there were 900 group meetings and 900 people that attended group meetings, and there were 835 people that attended individual meetings. This might be the first year that more people attended a group meeting than an individual meeting. That may be because working virtually is a little bit more difficult, but also people just might be a little bit more focused on wanting to be part of a group meeting. So we're constantly working and adjusting that. So you can see, again, we saw 1,800 people, 1,818 over the entire year. Fabulous. Very few of those people were repeats. Most of that was a unique person every single time. Very few was one person needing to do more than one meeting. And then also at that bottom section for Q4 2020, we can see 633 total participants for Q4. That's absolutely fabulous. Big part of that is because of National Retirement Security Month and getting people engaged for that. And that event happened all throughout October. And then it just kind of had a natural follow through for the next 2 months of people doing outreach to schedule meetings. So that year 2020 went pretty well. And I hope to continue that same kind of momentum and outreach that we've been doing, whether it's virtual or back in person at some point or whatever. It's been doing very, very well. Any questions from any of you, please?
I have an open question, and I really don't know if I'm. Go ahead, Nancy.
I think we've lost audio.
Yeah, Christine, did you have a question?
Yes, but I saw that Nancy was speaking, so I thought I would get off. But maybe it's just saying that Nancy, but it's really me. Anyway, I'm wondering, with the people leaving or transferring the money out, and it's been happening now for the last 2 years, is this an issue, or is there something? I'm assuming David would know because he's dealing with more people directly, but I'm not sure who could answer that question.
I can't.
I think we can both answer it. David, why don't you start off, and then I'll go over the rollover out report.
Yeah, so I am aware, I do interact with those employees. Hey, I plan on retiring in 6 months. What are my next steps that I should be taking? And we're always trying to make sure they understand the benefit of remaining, of leaving those funds here at San Joaquin. Benefits to do so. But I'm not actively knowing who is retiring, and employees certainly do not have to communicate with me if they don't want to retire, or if they plan on leaving. So I never. Well, every time we are aware that someone is separating, we try really hard to have that retention conversation. We just don't know who is separating, and it's every month that someone's going to leave. But every time we are aware, every time there is a pre-retirement seminar, every time there's a presentation where I can tell the audience is closer to retirement, or anytime it's just some kind of individual conversation, there's always a retention part in there. But after that, there's no mechanism that says, hey, you've separated, please consider these things. And by and large, most people that do separate, they are leaving their assets here. It just seems to be big chunks at a time that someone might retire with 200,000 or 300,000 and they've decided to move it somewhere else. But even when they call in and say, hey, I'm ready to transfer the funds over, we're having a retention conversation at that point. Not with me at that point, it's with the person processing it. They say, hey, this is a wonderful plan. There's a lot of benefits. There's no need to take the asset somewhere else. But for some employees, they really feel, oh, I'm supposed to do something. I have to do something. They feel that someone has planted that in their brain that they need to take some kind of action. They have to move it, which is not the case. We try really hard to make sure they know that's not the case. And for others, they just feel there is some better investment thing that they need, or something like that. And there are some circumstances where an employee wants to move out of state or something like that, and they feel, oh, I'm going to be too disconnected from this employer, and I'm afraid of being out of the loop, so I have to transfer it. But we try every time we are aware that someone is separating. So I'd say 1 out of 10 phone calls is someone closer to retirement, 1 out of 10 Zoom meetings, or even in person, 1 out of 10 people. So of the 1,800 people I spoke with, I'd probably say 180 of them, I'd say, hey, make sure you understand this retention-related stuff. This is a big benefit to you to try to leave this here, potentially. And we try to have that conversation. But I'm not sure, certainly others are retiring and they're not wanting to speak to anyone. They already have their person who's told them to take some kind of action. And they say, okay, great.
Is it a valid reason if they're moving out of the state is that a valid reason, or will they still be able to be connected? I would think online would work in any of the states, right?
Certainly so. But there are people that move to Florida or something, and they say, oh man, if I need something, I don't know what that avenue is going to look like, so I'm just going to transfer it over to my account at, the Bank of Florida or something like that.
Got it. Okay.
Something along those lines. But no, we try really hard to say, no, it's fine. But sometimes you hear something and you say, well, no, that can't be the case. Of course I have to. Oh, I was told by my uncle 30 years ago I have to spend it the day I retire, so therefore I'm going to, or something like that. It's hard to combat that. You never know where it's going to come from. But we try the retention conversation every opportunity. We know how important it is that these retirees who have a very, very effective plan and have very, very low fees and have lots of benefits to them, that they can be taken advantage of in some circumstances if they're going to transfer it somewhere else. And we really try to make sure they're aware of that.
Okay.
So yeah, Christine, I think great question, Christine, and it is something that we've been very much in touch with the last couple of years. I think it was the second quarter of last year when I first, I think, brought this issue to the committee's attention that, hey, this is something we need to have a little bit sharper focus on. In second quarter of 2019, there were over $6 million that rolled out of the plan during that quarter. So that was a bit of an anomaly. we really, David has, stepped up measures to really making an effort, as he's been talking, to explain to people they have a really viable option to leave their money right here in the plan and reap the benefits of this diversified portfolio, the committee's oversight, the due diligence done through your consultants. There's a lot of positives that leaving the money in the plan bring. And we've been monitoring rollovers every quarter. In the third quarter of 19, they went down. They were in the $3.5 million range. And then in Q4 of 19, it was 2.4 million. First quarter of this year, it was 2,695,000. Second quarter, it was 2,633,000. Third quarter, it was 2,662,000. And fourth quarter is this report you're looking at on screen, 2.7 million. So it's been consistently down under 3 million for the last 5 quarters now. So it has tapered, and I think this is more of a normalized level. Still on the high side. We'd still like to see that number drive it down lower. But we also have to remember that people are being solicited from outside advisors, financial planners that they may already be working with. Hey, now that you're retired, consolidate all of your assets with me and I can manage your whole portfolio for you. So those are pretty compelling arguments that individuals are facing. So the report you're looking at is the quarterly rollover out report. And you can see we've organized it or arranged it on this spreadsheet. So we've grouped it by where the money is going. Charles Schwab is this first block, and they took a pretty good chunk. They're always on this report, a fairly popular place where people are rolling out to. And then you can see the various places. Fidelity, Nationwide has a few in here. Pershing LLC, that's the local financial center credit union, goes through that broker dealer, and Vanguard on the bottom. So it's much better than it was, and we're going to continue to make every effort to bring it down even lower. But that's where we are in terms of rollovers out of the plan.
Thank you.
Bob,
Any other questions?
Are these all
Yes.
retirees? Do we know these are all retirees on this plan?
They're not 100%
Or this report?
retirees.
I apologize.
We know they're people that have separated employment,
Okay.
and that's really all we know. We don't know the age, but I would guess to say most of them would be retirees.
That was my guess
Or
too.
of
I just
that
wanted
age.
to clarify.
Yeah.
Thank you.
There are employees that are, going to another job somewhere else and they need to transfer it over to their job somewhere, or they're doing it in an intermediary or something like that to their next job. So that situation does happen as well. But by and large, these are people that are they seem to be out of the workforce.
Okay, thank you.
And Tammy and Brandy, that concludes agenda item 5, the program status report. So I will stop sharing the screen.
Thank you.
And I have not yet noticed if Dan has joined the call. I don't believe so.
We will move on to agenda item number 6, which is Mass Mutual Empower Current Agreement and Guarantee Account Interest Rate, and Tammy will be presenting for that.
Good morning, everyone. I just wanted to, this is just a brief update. The current agreement with Mass Mutual / Empower was for an initial 5 years, and that 5 years is ending on May 2021. And so there was an auto extension listed in the board letter in 2016. However, that extension was not noted in the agreement. So we're currently working with purchasing, and we will have an update later on next quarter.
Hey, Tammy, this is Jay. An update. What's the nature of the update, please?
You mean the nature of the agreement?
No, you said you were going to do an update before the next
Yeah,
quarterly meeting. What
because-
is that update going to entail?
Well, we're going to be talking with purchasing to know what our options are, because we could do a amendment, or we could go out to RFP.
Okay,
So
that was my
that's
question.
what we're looking at.
Okay. Is that something for discussion with us today?
No, this is just informational.
Okay, thank you.
Uh-huh.
Did you have anything about the guarantee account interest rate?
So yeah, thank you, Brandy. So in the initial 5-year agreement, it did note what the guaranteed account interest rates were going to be for the next 5 years, and of course that is ending. So part of the talks regarding an addendum or going out to RFP will be addressing the interest rates for the guaranteed account.
Tammy, it's Jay again. Might not it be helpful to find that out first before we decide to RFP or do an amendment?
Correct. And we do
And
have
it's-
some information from Empower, but we are still going to be meeting with purchasing to find out what our options are.
Okay, how much of that can be disclosed in today's meeting?
You mean the interest rates that we were just provided by from Mass Mutual, Empower?
Yeah, I'm going to cut to the chase here. This has been a little bit of a sticking point with me for the last several years, and I've mentioned it on numerous meetings that we've had. But, as we just saw in the presentation, the bulk of the county's money, almost 40% of it is in the GIA, and it's been going down, down, down. Meanwhile, we see the value of bonds have been going up, 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 even though, the interest rate for that's been going down. And so, I realized there was a floor. I believe we're right at the floor now. We've now gone through, what do you want to call it, a transition, if you will, from Mass Mutual, who we did the 5-year plan with, to Empower. A lot of things have happened that essentially weren't on the table when we entered into that 5-year agreement. And I would like to have some sort of an idea of what this GIA percentage is going to look like if we extend this thing for another year. At least some sort of a sense of, is it going to remain the same? Is it going to go up? Is it going to drop precipitously? Do we have any idea what's going to happen?
So, Jay, this is Brandy. We have some preliminary information that's so new that honestly I haven't even looked at it yet, and we'll be meeting with Vincent. And what I can commit to, and I appreciate your comments, is that let us go through the process of reviewing the information, and then I can work with Jason if we need to schedule a special meeting to share that information with the committee.
Okay.
Ultimately, Jay, this is Jason. I'll chime in.
Yeah.
Ultimately, the HR director still has the authority to extend the agreement one way or the other. I don't recall the last time the RFP was done, but it feels fairly recently. I want to say we did it prior to this last agreement. So there is no requirement, but any discussions, obviously, if the chair wants the committee's input, and I'm sure that she does, just from a timing perspective, if the existing agreement expires in May, our next meeting isn't scheduled until the end of April. That would be pushing it. So more likely than not, a special meeting would be appropriate. But I also say that, we don't want to end up in a situation where we run out of contract with Empower. So special meeting, everybody keep that in mind. It's something that will need to be resolved prior to the expiration of the contract. But I have a lot of confidence that will happen. It has happened previously with Mass Mutual, specifically with Bob. I think we're in good hands, at least in terms of being able to get something in place so that we can conduct an RFP, because I will openly say, based on my experience, trying to conduct this kind of RFP in 3 months is pretty unlikely. It just takes a lot of time. So special meeting, probably the best way to handle it, to get a full, robust discussion in order to make sure that an appropriate, at the very least, stopgap is put into place prior to May 2021.
I think we need to do everything we need to do in order to get the best value for us in our 457. As we just saw, we've got almost 40% of $500 million. That's almost $250 million, and something that's been eroding on the income side. And the bulk of that is people over 60 who are going to be relying on that going forward. And we saw, you know, some of them have single balances in there, and that's a meaningful decline in their earnings. And we don't know how Mass Mutual or now Empower has that invested. We don't see a report or whatever as to how the earnings that fund that take place. But I can tell you in my own 401k holdings that I have from the private sector, I own bonds, and those bonds have been kicking butt. Even though the interest rate on some of those things is as low as 3.5% or 4%, I bought those things back when the rates were higher than they are now, and the principal gain, the unrealized principal gain on those things is huge. And if I talk to people, oh, it only kicks off 3.5% interest, so standing there with my shoulders shrugged. In the meantime, I've made a 20% gain on the principal value of those bonds, and that's not what you'd see when I would talk to you. So, like I said, I don't know how that GIA money is being invested on the record keeper's side, but I think we should get a more robust return than our 2.3%.
Perfectly valid point, and a negotiable one as well.
And sorry to chime in, but this is Vincent from Hyas, and Tammy alluded to this. We're certainly prepared to do a benchmarking study of what we've seen with recent competitive RFPs on pricing and rates. So I'm happy to share with that whenever the committee or Brandy would like. So.
Thank you, Vincent, and everybody for your comments. And Tammy and I are trying to meet with Vincent to go over the information so that we can bring it back to the committee. And I agree, Jason, with your assessment. Even if it's a stopgap, we need to determine what we're going to do. Are there any other questions or comments?
I apologize to chime in again. This is Vincent. I have to hop off for my 11 o'clock other client call. Thank you, and I apologize. Bye, everybody.
Oh, thank you for accommodating us. Thank you. Are there any other questions or comments about agenda item number 6, the current agreement and guarantee account interest rate? Okay. Bob, just checking in. It's 11. Have you seen Dan call in yet?
He's here.
Yes, Dan is here.
I'm glad everybody can see who is on. Welcome, Dan. So we will go back to agenda item number 4, which is the introduction of Empower Senior Vice President of Government Business, Dan Morrison. So Bob, we'll let you do the introduction.
All right, thank you very much. So everybody, very pleased to have Dan with us today. As Brandy mentioned, Dan is the Senior Vice President of Empower, and he is the leader of our government retirement business. So very pleased to have Dan here. So with that, Dan, take it away.
Great. Well, thank you for having me this morning, and appreciate the opportunity to say hello. I thought I'd just give you a quick synopsis of what's happened over the last several months with the bringing together of Mass Mutual Retirement Business and Empower Retirement, and talk about our short-term go forward and what you can expect over the coming months. Does that sound appropriate?
Absolutely.
I see some heads nodding. So back in September, we announced publicly that Empower was in definitive agreements with Mass Mutual to purchase their retirement business, and that we targeted to close that business pending regulatory approvals by the end of December. We did get those approvals, and in fact closed the transaction as of 12/31, so effective 1/4 of this year. All of the associates and plan sponsors in the contracts effectively were reassigned to Empower retirement. A couple of things that I will tell you, and I came in at the tail end of that discussion. So with this transaction, we are going to honor all the terms of any of the contracts. So current pricing, current fixed rates, current floor rates, any of the provisions that are in place. And I know that that we are coming up on the end of the current contract and have, happy to help however we can there. We've put some numbers forward, which I anticipate you will find competitive, and Vincent will show you benchmarks to the same. We certainly want to continue our partnership, but we'll honor those contract terms. For the time being, everything will be business as usual, right? So you may have seen, or your members may have seen, some changes to the logos on the website, but the website alias is still the same. The phone numbers are still the same. So the access remains as it was. It would just be rebranded in some instances to Empower. Now, over the coming months, there will be more material changes. Specifically, we're going to move all of the legacy Mass Mutual plans from there are 3 legacy record-keeping platforms, and we're going to move all of those plans over the course of the next 2 years onto the Empower record-keeping platform. When we do that, some of you as plan sponsors will see, I think, advancements in the technology that's available to you. So the reporting and tools and how you access information. And then your members will have access to very state-of-the-art tools to see their net worth, help them manage their account, access to app, so both for iOS and for Android. So a lot of enhancements will come. We are, as I've mentioned, we're going to go through a migration process to move the plans from one platform to the other. Just to give you some context, Mass Mutual had roughly 25,000 retirement plans. So we will move all of those plans. We're not going to do that in one move. It's a lot of plans. I will share with you that Empower, we have been very focused. We've been doing government DC work predating even the Code 457. So for 60 years, we have a lot of experience in the space. Over the last 20 years, we've gone through 14 transactions or led 14 transactions where we brought 2 organizations together. So a lot of experience to bring the groups together. We have a team of over 350 associates who are dedicated exclusively to ensure a successful migration. We will, because it's so many plans, we're going to migrate the plans in what we call waves. So waves will occur starting at the end of second quarter. We're going to do a very small number of plans in a pilot. And then every other month, effectively through the end of third quarter of 2022, we're going to move plans through these waves. The transitions will be very different than a conversion. So with the waves, it'll happen over a weekend. There won't be any blackout. We'll maintain plan and participant history. And from a plan sponsor perspective, we're going to map all the payroll files and all of the inner workings that are already set up with Mass Mutual. So it should be pretty straightforward and shouldn't be a heavy lift. We did finalize a comprehensive review and plan for all of those migrations last week. We will be coming to you through Bob over the course of the next couple of weeks on San Joaquin. Here's where we think it would make sense to make a transition. We'd like to get your feedback at that point. Here's the communication plan. Here's what we're going to need from you. So those details are forthcoming in the coming weeks. So that is a high level of what's happened and where we are today, business as usual, where we're going tomorrow, a weekend wave at some point in the future. All the while, Bob and the team, it was critical for us to retain the staff. We, in fact, retained about 1,800 associates. 100% of the client-facing associates were offered a position and accepted. So this is a relationship business, and it's important. It's critical for us to have Bob and his peers as part of the team, and so you will continue to work with Bob just as you have in the past. So I'll pause there and happy to answer any questions or go down any other paths that you might have.
Does the committee have any questions for Dan?
This is Fonse. I'm looking forward to those technology changes, especially to the app and to the online platform there.
Right. And if you'd like to see advanced looks at those, we can certainly coordinate demos or get you videos, and it's certainly an advantage I think that you all see.
I just want to see basis, starting basis. For some reason, we're unable to see that right now in our apps.
Okay.
And if the committee would like, at a future meeting, they can invite someone from Empower to join us who's familiar with that new system, who can provide a demonstration for you so you could see, if you're a participant, what types of things will you be looking at. So Tammy, Brandy, just let me know if you'd like to schedule that for a future committee meeting. I'd be happy to arrange that.
Thank you. Any other questions for Dan? Dan, I appreciate you joining our meeting today and introducing yourself and talking about some of the changes that we can expect moving forward.
Right. Well, thanks for having me, and thanks for your business. Look forward to work more closely with you going forward.
Thank you. Okay, next on our agenda, I see we have other business, but I noticed on our last back page that we have a program status update related to loans with Tammy. So I'm going to jump ahead and have her do that before we do our closing other business.
This is just real quick. I know that Bob had reported how many loans were on the books as of the end of December, but as of today, we currently have 49 loans, and none of those are residential. So I just wanted to bring that information to the committee.
Are there any questions for Tammy? We'll move to our last agenda item. Does any of the committee members have any other business that they would like to address today? Okay, hearing none, we'll do a final public comment check with Donna.
No public comment.
And we do not have any final public comment. So we will go ahead and adjourn. It's 11:13. Thank you, everybody, for your time today. It's very much appreciated.
All right. Thank you. Bye-bye.
Bye-bye. Thank you, everyone.
Hi, everyone. Nice to see you.
Thank you, Brandy, Tammy, Donna, well done.